Welcome to Insight Lens, where we uncover the hidden forces shaping global power and finance. China is entering a gold fever unlike anything seen in its modern history, and the discoveries it has just announced are drawing worldwide attention. According to the South China Morning Post, in less than a year, China has reported two colossal gold finds at opposite ends of the country, one in central Hunan province and another in northeastern Liaoning province. Each of these deposits is estimated to contain more than 1,000 tons of pure gold. By today's market price, the Hunan mine alone could be worth more than 600 billion yuan, around 83 billion US dollars. This is no longer a mere geological discovery. It is being treated as a strategic national treasure, a resource of global scale. As for the Liaoning mine, Chinese geologists estimate its reserves are also near the 1,000-ton mark, with a total value of tens of billions of dollars. What is particularly striking is that both gold mines were announced at a time when China's economy is facing severe headwinds: a collapsing real estate sector, shrinking exports, a depreciating yuan, and a sharp loss of market confidence. International experts have been asking, why would Beijing announce two high-profile gold discoveries of the century at such a sensitive moment? Was it merely coincidence, or part of a carefully calculated strategy? Some argue that these high-profile announcements are not simply geological news, but a political and economic move meant to calm markets and create the impression that the nation still holds vast reserves of value. Yet analysts warn that no independent evidence has confirmed the actual reserves of these deposits. The journey from discovery to full-scale extraction is long, costly, and fraught with risks. Beijing, however, seems less concerned about international verification. What it needs most right now may not be the physical gold itself, but the confidence generated by the story of gold. And even if these deposits prove real, no one believes they will satisfy Beijing's hunger for long. For years, China has shown little interest in hiding its ambition to accumulate as much gold as possible, both domestically and abroad. When the reserves beneath its own soil are not enough, China extends its reach all the way to Africa. Its first major target, Ghana. When the reserves beneath its own soil cannot satisfy its appetite, China extends its hands overseas, most aggressively toward Africa. Its very first target, Ghana. Ghana has long been one of Africa's largest gold producers, but in recent years, local communities have been overwhelmed by what many describe as a storm of mining unleashed by Chinese operators. Thousands of miners from China poured into the country under the guise of tourism or small businesses, only to establish illegal mining camps in remote forests and river valleys. These groups did not arrive with shovels or pans. They brought in heavy excavators, industrial screening equipment, powerful generators, and toxic chemicals like mercury and cyanide. Even worse, some outfits were protected by armed security guards, creating a shadow industry that looked more like a paramilitary operation than small-scale mining. The devastation has been immense. Forests stripped bare, rivers poisoned, and farmland rendered useless. Locals have paid the highest price, communities displaced, livelihoods destroyed, and health risks rising. What started as a hunt for gold has turned into an ecological and social disaster. And it is not only Ghana. China has replicated the same model across the continent. Similar operations have been reported in the Democratic Republic of Congo, Zimbabwe, Cameroon, and more recently, Sudan. Wherever there is gold, Chinese miners seem to appear, backed by money, machinery, and organized networks of protection. On the diplomatic stage, Beijing repeatedly denies responsibility. Officials insist these were the actions of individual Chinese citizens acting independently of the state, but this explanation is hardly convincing. How could ordinary citizens smuggle in heavy excavators, import restricted chemicals, hire armed guards, and transport hundreds of kilograms of raw gold out of Africa without at least tacit support from higher authorities?
The uncomfortable reality is that China's overseas gold rush is unlikely to be spontaneous. Instead, it suggests a deliberate strategy to secure as much gold as possible, regardless of environmental destruction, legal boundaries, or international criticism. Gold, in this sense, has become not just a resource, but a weapon, one that Beijing is willing to wield across continents.
While China's overseas gold rush makes headlines, its current ally Russia has been pursuing a far more discreet yet equally ambitious path. Moscow is not only ramping up production within its own borders, but is also expanding its gold operations deep into Africa. Russia has struck deals with friendly governments such as Mali, Burkina Faso, Sudan, and the Central African Republic, nations rich in untapped reserves but lacking technology and skilled labor. In exchange for military or security assistance, Moscow secures lucrative mining rights or joint venture opportunities. In other words, Russia is effectively trading its political influence for gold, creating a geopolitical business model rarely seen before. Two names dominate Russia's gold industry: Vunuk Geologia and Polios Gold, the country's most powerful mining giants. Polios, in particular, controls the Sukhoi deposit in Siberia, considered the largest untapped gold reserve in Russia, with an estimated yield exceeding 2,000 tons. This project is seen by both Russian officials and financial experts as nothing less than the cornerstone of the nation's long-term economic strategy for the coming decades. The development of Sukhoi Log is expected to turn Russia into one of the world's foremost gold superpowers. Clearly, both Moscow and Beijing are accelerating their gold accumulation. Yet this raises a critical question. Are they simply hoarding gold reserves for themselves, or is there a deeper handshake behind the curtain? Gold has long been seen as the ultimate safeguard of value, the foundation that underpins all assets, the protective armor behind any currency. And if we look back at history, the way the US dollar rose to global dominance is the clearest example of this truth. In 1944, as Europe and Asia lay devastated after the Second World War, the United States stood as the only major power left relatively unscathed. Washington seized this golden opportunity to establish a new global financial order. Over 730 delegates from 44 countries gathered at Bretton Woods, New Hampshire, where the U.S. imposed a monetary framework the world had little choice to accept. Under this system, the U.S. dollar became the centerpiece of global finance, fixed to gold at $35 per ounce, while all other currencies were tied to the dollar rather than directly to gold. In simple terms, Washington told the world, instead of hoarding gold, hold dollars. Every dollar is guaranteed by real gold in America's vaults. At that time, the message was convincing because the United States controlled the largest gold reserves on the planet. Other nations did not accept the system out of blind faith, but because they had no better option. The gold standard became the shining cloak that gave the dollar its aura of legitimacy. Today, China appears to be weaving a similar cloak for the renminbi. Beijing makes no secret of its ambition to craft a Bretton Woods 2.0, in which its currency becomes the standard of global trade. That is why China tirelessly accumulates gold, loudly announcing reserves said to total as much as 2,000 tons. These declarations serve as an unspoken message to the world. This is a currency backed by real value. You can trust it. For Russia, however, gold is not about global domination. It is about survival. When the West froze over $300 billion of Moscow's foreign currency reserves in 2022, a harsh lesson was laid bare. Any asset held within Western banking systems could vanish with the stroke of a pen. From that moment on, gold became the only asset offering absolute security. Unlike the dollar, which Washington has turned into a weapon of sanctions, gold is tangible and cannot be frozen so long as Russia controls its vaults. In a global financial system shaken by American influence, gold became the guarantee backing the ruble, allowing Moscow to reassure its partners, our currency is supported by eternal value, something no one can erase. At a deeper level, gold has enabled Russia to sustain trade with friendly nations such as China, India, and the United Arab Emirates. Cut off from SWIFT, the bloodstream of global commerce, Moscow was forced to build its own path. It sold oil, gas, and coal in exchange for gold, then used that gold as a decentralized medium of exchange. This allowed Russia to keep buying microchips from China, industrial equipment from India, and luxury goods from the Middle East without relying on dollars or euros. Gold became the bridge, shielding Russia from the relentless financial assault of the West. For Moscow, the 2022 freeze of over $300 billion in foreign reserves was a turning point, a brutal reminder that assets stored in Western banks could vanish overnight. That single stroke of sanctions taught Russia that its survival could no longer depend on the dollar or the Western-controlled financial system. From then on, gold was no longer just a reserve, it became a lifeline. Unlike the dollar, which Washington wields as a sanctioning weapon, gold is tangible, unfreezable, and fully under Moscow's control. It became the ultimate guarantee backing the ruble, helping Russia assure its trading partners that its currency was not simply paper, but supported by eternal value that no government could erase. This shift allowed Russia to sustain trade even while cut off from SWIFT, the world's financial bloodstream. Oil, gas, and coal were sold for gold, and gold in turn became a decentralized medium of exchange. Through this mechanism, Moscow continued buying microchips from China, industrial equipment from India, and luxury goods from the Middle East, all without the dollar or the euro. Gold became the bridge that shielded Russia from financial isolation and allowed its economy to keep breathing under Western pressure. Yet the game Moscow and Beijing are playing does not stop at financial survival. They are reaching for something far larger, reshaping the rules of the energy market itself, the very foundation of the dollar's global supremacy. The battle being waged by Russia and China is not confined to financial reserves. Their ambitions extend much further, to the very heart of the global energy market, particularly oil, long dominated by the petrodollar. At the center of this struggle lies OPEC+, the alliance of oil-producing nations that historically helped stabilize markets in ways favorable to Washington, especially when the United States was still the main security guarantor in the Gulf. But the landscape has shifted. Today, OPEC+ is no longer America's obedient partner. With Russia embedded in its structure, the organization is beginning to assert a more independent role. According to multiple reports, OPEC+ has repeatedly increased oil output during the first half of 2025, despite a global market already flooded with supply. Most striking was a planned production hike of nearly 500,000 barrels per day, set for September. This marked a major departure from the past. Gulf states once avoided such aggressive increases during periods of low prices, fearing friction with their U.S. ally. But now, they appear willing to tolerate falling prices in exchange for reclaiming market share. And in doing so, they put direct pressure on America's shale oil industry. Shale producers in the U.S., with their high extraction costs, cannot survive long in an environment of sustained low oil prices. Already, many companies have begun scaling back investments, shutting down rigs and reducing operations since early 2025. Meanwhile, Russia has benefited from these shifts. It has not only maintained its share through bilateral deals with China and India, but has also quietly expanded its influence within OPEC+. Step by step, Moscow has steered the organization away from America's orbit, preparing members to consider new methods of payment, whether in renminbi or even in a future joint currency backed by gold, instead of relying exclusively on the US dollar. China, for its part, no longer hides its ambition to create an energy supply chain independent of the dollar. In recent years, China has signed multiple long-term contracts with key exporters like Iran, Russia, Saudi Arabia, and the UAE, using the renminbi as the currency of settlement. Alongside this, China continues to amass gold on a massive scale, not only to protect its currency, but to prepare for a new financial energy system in which gold may once again serve as the ultimate anchor of real value. Taken together, these moves reveal a coordinated strategy. Russia and China are binding monetary policy to oil in order to rewire the global financial system. Should a gold-backed currency emerge, and if OPEC gradually shifts its oil transactions away from the dollar, the consequences would be seismic. It would strike directly at the foundation of U.S. power. The petrodollar, the pillar of Washington's global supremacy for half a century, would no longer be untouchable. And with that, the world may stand at the threshold of a new financial order, one no longer centered around the American dollar, but around gold, energy, and the rising ambitions of Moscow and Beijing.